Hey, how's it going? Bill Leatherman here for Money Evolution. In this video, I'm going to be talking about how your retirement income is taxed. Now, I'm sure you're probably already well aware that the U.S. tax code is incredibly complex and there's tens of thousands of pages of rules and regulations. And unfortunately, as complicated as that is, I've got some bad news. Unfortunately, it just gets a little bit more complicated as you go into retirement because there's a lot more of those moving pieces that you need to know and keep track of. So if you think about it, while you're working and saving money, things were probably relatively simple from a tax standpoint. You made some money, you paid some taxes. If you put the money into a tax-deferred traditional retirement account, you got to deduct that off of your income taxes for the year, reducing the amount of taxes that you would owe. But in retirement, that all sort of reverses. And again, there's a lot more of those moving pieces. You're going to start to withdraw that money from those retirement accounts. You've got Social Security payments, and you've got forced distributions from those retirement accounts, whether you need the money or not, depending on how old you are, either at age 73 or at age 75. That, for a lot of people, may push you up into a higher tax bracket. Being in a higher tax bracket could also mean that you pay something called IRMA, which is an income-related monthly adjustment amount that can make your Medicare costs go up as well. So in this video, I'm going to be diving into all of that and really simplifying it as much as we possibly can so that you can understand how your income in retirement is potentially taxed. And from there, we can start working on some ideas and strategies and how you could potentially reduce some of that tax impact as you go through retirement. But real quick, before I get into the content of today's video, we've got some great free resources, and we've got an excellent resource page that we have built out on the moneyevolution.com blog. And if you want to learn more about any of that, including some of our financial planning programs, we'll put links to all of that in the description, or just head over to moneyevolution.com. Okay, so let's jump in here. So the first thing we're going to do is we're going to separate all of your income into two very broad categories. The first category is what we're going to call non-portfolio income. And the second category, of course, is going to be money that's going to be distributed or earned from your portfolio assets. And we'll dive into each of these in a little bit more detail here. But most of us are going to have things like Social Security benefits. In fact, I would say a very, very high percentage, if not everybody watching this, will have Social Security benefits. And let's start with that. So Social Security benefits are going to be subject to ordinary income taxes, and ordinary income taxes are going to be things that are taxed at your income tax rate, the base rate, essentially. So if you think about your marginal tax bracket and you say I'm in a 22% or a 24% tax bracket, that's what we're referring to here. Social Security benefits never used to be taxable going way back when it first came out. But in 1984, in an effort to kind of get Social Security back on track from eventually running out of money, they started to effectively tax the Social Security benefits. So in 1984, they enacted something that says up to 50% of your Social Security benefit could be subject to tax. And then I think it was like 1994, maybe about 10 years later, they enhanced that or changed that a little bit and said up to 85% of your Social Security benefits could be subject to tax. So these original measures that they use to determine if your Social Security benefits are subject to tax were made in 1984, and they've never been adjusted for inflation. So if you're a single tax filer in retirement, if you make $25,000 or more a year of what they call combined income, then 50% of your Social Security benefit would be subject to tax. And if you make over $34,000, then it's up to 85%. So part of that combined income is going to be your Social Security benefits itself. In fact, half of your Social Security benefit would be in that combined income calculation. They're also going to add in tax-free interest that you may earn on things like municipal bonds to your adjusted gross income to come up with that. So what we generally tell people is almost everybody is going to be subject to this Social Security tax, and it's probably going to be at that 85% level unless you're in a very low income tax bracket. Just real quick, if you're married filing a joint tax return, it doesn't get any better. It's $32,000 of combined income, so that's total household AGI plus the tax-free interest plus half of your Social Security benefit would be in that calculation, be 50%, and it's $44,000 would be the tax at 85%. Other things that you could have that would be part of this non-portfolio income stream here. Pension income, that's going to be taxed also. I think all of this pretty much is going to be taxed at your ordinary income tax rate. Maybe you retire, but your spouse is still working, or you're working a little part-time job. So if you have any earned income from employment, that would also be part of this. That would all be taxed at your marginal tax bracket. So that's all stuff that's going to stack up on this. One other thing that some people are going to have is if you have real estate income, so you have rental properties or something like that, that's also going to be part of this non-portfolio income, and it's going to be taxed at your ordinary income tax rate, but that's going to fall into a different classification as well that we're going to talk a little bit more about, called investment income. And there's an extra tax that you could get hit with if you're over a certain threshold that I'll talk about in a little bit. So as I said in the opening, your taxes kind of do get a little bit more complicated as you go into retirement. So those are things all going to pretty much add up to your marginal tax bracket in your income tax base. And then as we go into portfolio assets, in fact, I'm going to move that down here, and we're going to start a new section here. And the portfolio, if you think about it, and something I've talked about in other videos, is all of your investment assets are really going to fall into one of three buckets. And we call these our asset classification buckets, or assets by tax type. The first one is going to be sometimes what we refer to as non-retirement assets. So that's like brokerage accounts, it's bank accounts, money market savings, CDs, mutual fund accounts, things like that, that are not part of an IRA, not part of a Roth, not part of a 401k or any other employer-sponsored retirement plan. The second bucket is going to be the traditional bucket, and that could be traditional IRAs, it could be 401k plans that are traditional, meaning that you generally got a tax deduction as the money went into it, but when that money comes out, it's all going to be taxable at your ordinary income tax rate. So that's important to know, that ordinary income, and that's going to be a term we're going to talk about a lot there. Ordinary income is going to be distributions from that traditional. And of course, the third bucket is going to be our tax-free bucket, or the Roth bucket, essentially. So that could be Roth IRAs, Roth 401ks, and as long as that money is qualified when it comes out, a qualified distribution, it's going to be completely tax-free when you distribute that money. So we'll just say no tax on that unless it's a early distribution of some sort. Now, going back to our non-retirement account bucket, there's really a couple of different classifications that could fall into. That could be, you could have tax-free money here as well. So if you do have things like municipal bonds, those are generally going to be tax-free from a federal standpoint, and if you buy the tax-free bonds in the state that you reside in as your primary residence, that could also be state tax-free as well. Sometimes even triple tax. You get, if you have like a city of Detroit tax and you buy a Detroit bond and you live in Michigan or you live in Detroit, you could also avoid that city tax as well. So tax-free income there, and then you could have ordinary income here too as well, and that's going to be any short-term capital gains, and then very important to note here too, that's going to be interest income. So interest income is going to be taxed at the ordinary income tax rate. That's generally going to be your highest income tax rate that you're going to pay on anything. So that ordinary income is sort of like, I'd say, the worst income that you could have because it's going to be taxed at that highest rate. The third type of income that you could have out of your non-retirement account is going to be something called a tax preference. If I could spell here, let me back that up here. It's hard to talk and write at the same time. So tax preference, and that is going to be taxed at, for most people, probably 15%. But depending on how much income you have, you could actually qualify for a 0% tax preference rate, and that's going to be applied on dividends, qualified dividends, I should say. So there's going to be corporate stock dividends, and it's going to be long-term capital gains is going to apply, is going to, basically get that 15% preference rate on that. So it could be 0, it could be 15%, or if you're basically, I forget the exact limit there, but it's in the 500,000, 580,000 range for married filing joint. If you're over that level, it would actually go up to a 20% long-term capital gain tax rate. Okay, so as I mentioned earlier, there's going to be an additional tax that's going to apply to anything that's classified as investment income. And I'll go through the list of what that is here in just a second. This is something that was created back when they did the Affordable Care Act, or some people refer to it as Obamacare, and it's called the net investment income tax. And what it is it's a 3.8% that's going to apply on the lesser amount of investment income you actually have, or the amount that exceeds the threshold. And so those thresholds were put out, I think it was like 2009 or 2010 when the program first started. And just like what we talked about with Social Security, those thresholds have never been adjusted for inflation. I don't think there's any plan to adjust those for inflation. So if you're single, filing a single tax return, that threshold is $200,000. And if you're married, filing joint, that's $250,000. So effectively, if you had, let's say, $250,000 of total ordinary income, and you're filing a joint tax return, and then on top of that ordinary income, you had $50,000 of investment income, then all of your investment income would be subject to that 3.8% tax, plus whatever other income tax rate you were paying on the rest of that as well, too. This would just be on top of that. And let's say if you had $225,000 worth of ordinary income and that same $50,000 of investment income, then only $25,000 would be applied with that 3.8% tax. So it's going to be the lesser of the amount of the actual investment income that you have, or it's going to be the amount that you exceed the threshold by. And again, if you're single, that number is going to be $200,000. So what's considered investment income? Well, pretty much all the stuff we were talking about in that non-retirement account bucket. So it's going to be things like interest, it's going to be capital gains, and it's going to be both long and short-term capital gains. It's going to be dividends from stocks. It's also going to be if you have things like the real estate income that we talked about earlier. If you have real estate income, that's also going to be considered investment income. What's not considered investment income is going to be distributions from your retirement account. So if you're taking a distribution or withdrawal from an IRA or a Roth IRA account or even a 401k plan, that is not going to be considered any of those investment income assets. But anything basically where you're investing money, you're getting a return that's not a distribution from a retirement account, that's going to get hit with that 3.8% tax. So a couple of these things like the long-term capital gains and the dividends, those are going to be taxed at that preference rate, which might be 15% or it might be 20% depending on where you're at, but that would be 3.8% on top of that. But if you have long-term or short-term capital gains, or you have this real estate income or interest income, and you're in a 22% tax bracket, you're going to pay that 22% ordinary income tax rate, and then you're going to have the 3.8% taxed on top of that. So you can see how this can really start to escalate, and really it requires managing the portfolio and understanding how all these different moving pieces. Sometimes it's just not avoidable because of wherever you're at with your income tax bracket, but this is sort of the things that we want to look at and plan out the long-term impact of these different income streams that you have to see if there's any way that you can optimize that to maybe reduce some of that money that you would pay in that 3.8% net investment income tax. Okay, so now two more things that we want to keep in mind and we want to consider as we're trying to understand how our retirement income is going to be taxed. The first of those is going to be IRMA. I think I mentioned this at the beginning of the video. That stands for the Income Related Monthly Adjustment Amount. And what that is if you're over certain thresholds, you're actually going to see an increase to your Medicare Part B premiums and your Medicare Part D prescription drug premiums. In fact, actually, if you hit the highest level of IRMA, that amount that you'd be paying for Medicare Part B would be over 3 times as much as it would be if you didn't have the IRMA applied. So again, for some people it may not be possible to avoid this IRMA, but as we start talking a little bit about some generalized strategies that you could do, that would be the goal, is to try to keep us from hitting that IRMA or maybe reduce the amount of IRMA that is going to apply to our situation there. So IRMA is going to be one of those things. We sometimes even refer to it as a stealth tax because it's really not a tax, but because of how high your income goes, it's something that costs you money. So I consider that to be a tax. The second thing here is going to be required minimum distributions. And They changed the rule. I think this has been 3 or 4 times in the last 5 years or so. It used to be 70 and a half, then it was 72. The latest one, I guess that's the third change that was coming out here with the Secure Act 2.0, is now the required minimum distributions kick in at either age 73 or age 75. And that's going to depend on when you were born. Basically, if you were born 1960 or later, it's going to be age 75. If you were born before 1960, it's going to be age 73. And what that is it's basically for the money that you have in your traditional retirement accounts, you have to start taking a minimum distribution out every year. And it's a formula, there's a divisor. Basically, in the first year, it's going to work out to something a little bit less than 4%. And they're going to calculate that based off of your December 31st account balance for all of your retirement accounts, all of your traditional retirement accounts, the IRAs and the 401k plans included there, and you're going to be mandated to take a distribution. So for some people, depending on how much money you have in those accounts, that could very well potentially push you up into a higher tax bracket. It could force the IRMA on you. It could, raise some of the other income so that you're getting hit more with that net investment income tax. There's a lot of things that could happen. So well before you get to that age 73 or 75 period of time, you're going to want to understand that and understand if that's something that's going to affect you. So let's talk a little bit now about some of the strategies, and this is going to be very generalized here. But again, having an understanding of where your money's at across those 3 primary tax buckets, the non-retirement, the traditional, and the Roth, and understanding how that money in your non-retirement accounts is going to be paying dividends or distributions or capital gains. But some strategies for the non-retirement account, for example, is you could look at doing things like municipal bonds. If you're in a high tax bracket, that makes sense, I think, for a lot of people. That's tax-free income. Although that tax-free interest is going to get added back into something they call the modified adjusted gross income. So unfortunately, it won't keep you from that IRMA level, or in other words, the municipal bond interest isn't going to save you from that necessarily there. So municipal bonds there focus on long-term capital gains and dividend income. But the long-term capital gains, the longer you can defer those gains and then maybe control or have some control over when you sell those investments and decide to take the gain on that for income tax purposes. If you hold something through the rest of your life, the nice thing about these non-retirement accounts, there's something called a step-up in cost basis. So even if you bought Apple stock 25 or 30 years ago at an extremely low price and you've got millions of dollars in Apple stock at a very low cost basis, when that gets passed on to your beneficiaries, there's a step up in cost basis on that, so there's no taxes that would be due. Nobody would pay the income tax on that. Roth conversions, I've talked a lot about on the channel here. So Roth conversions are something that makes sense for a very high percentage of the people that we do financial planning for. And basically what we're looking for is a tax arbitrage situation, a situation where your income tax rate in one year is lower than what we think it's going to be in a future year. And if that's the case, it's generally going to make sense to do that Roth conversion. For a lot of our clients, especially if they retire early, before maybe Social Security kicks in, for example, they might have some very low tax years where they can do those Roth conversions in that time period. And then as they start getting Social Security and maybe other forms of income down the road, and eventually when those RMDs kick in, where it really starts to escalate, we can start doing some Roth conversions that could bring that Roth conversion or that required minimum distribution down a little bit there. Okay, so now let's talk about some of the strategies that we can do to maybe try to minimize a little bit or lessen the effect of things like IRMA or that net investment income tax. So the first thing we're going to want to do, and the starting point of any good tax planning, is really to get an understanding of where you're at right now. And the first thing we want to do is want to go back to what we were looking at earlier, as those non-portfolio income sources. And if you're working right now, you may still have money coming in from your job or your business. You may have some of those dividends. You may have interest income if you have a bunch of CDs or money market accounts and things like that. And so you may be at a very high level of income. And then maybe you're going to retire, but your spouse is going to continue working for a few years. So maybe that income goes down a little bit, and then you retire. But let's say you both retire and you're not ready to turn on Social Security benefits yet, or maybe you're not even eligible for Social Security, you may see a big drop in your income because you might not have anything coming in other than maybe that income coming in from those portfolio assets that are in that non-retirement account. If you have real estate income, you're going to want to think about that, and maybe you're going to have some level of income that's going to continue for a while. Eventually, maybe you collect your Social Security benefits, and then maybe a couple years later, your spouse collects theirs, and then eventually, if you don't do anything, you don't do any forward-looking tax planning, you may see a huge run-up in the required minimum distributions, pushing you up into a higher tax bracket. In fact, for a lot of the plans that we do, we oftentimes see that people's RMDs could very well push them up into a higher tax bracket that they were in while they were working, if you can believe that. So during this phase right here, and it's going to be different for everybody, and it's obviously not drawn to scale with any kind of precision here, but these are what we refer to oftentimes as low tax years. And this is where it gives you an opportunity in many of our planning situations to do things like Roth conversions, to get money out of those traditional retirement accounts that'll bring down those future required minimum distributions and take advantage of, in some cases, a 12% or 15% tax bracket or a 22% tax bracket, and avoid you going up into one of those 28 or 32, 37% tax brackets later on. But understanding that, and obviously there's a lot of moving pieces to that, and understanding how you have your assets broken up into those different categories, our three buckets, our non-retirement, our traditional, and our Roth. And so this is something that you even want to be thinking about and understanding in the years before you retire as well, too. Depending on what that long-term tax situation looks like, it's going to determine where you should be saving that money. Should you be saving that money in a traditional and taking that tax break right now and pay taxes later? Some of that's going to determine based on the fact if you have those low tax years or how high of a tax bracket you might be in retirement. So you're going to want to, you're going to keep that in mind. How much money you're going to be withdrawing from those accounts, and this is something that's going to be in retirement. So you might say, okay, yeah, I don't have any income coming in, but I need $250,000 to live on, and the only real account that I have is a traditional retirement account, and you got to pay ordinary income taxes on all of that. So that may not give you that same opportunity to do the Roth conversions and some of these other strategies. So you really want to lay this all out. I went through this part really simply, but just to get you thinking about a few of these things. You can also think about the strategies that you're doing inside that non-retirement account. Focus on things like long-term capital gains, buying things that aren't going to pay a bunch of short-term capital gains or have a lot of turnover within the portfolio, which could mean a big tax bill every year. You want to basically you want to be the one in control of when you pay the taxes on it, not have some mutual fund or some investment kicking off a bunch of gains and dividends and things like that you really don't want as far as your tax bracket goes. So anyway, I hope that made sense. I know we went through those strategies a little bit quickly. I've got a lot of other videos where I do take some deep dives on some of that. If you like the video, I think this was a long one. I don't know how long I put this one together for, but thanks for sticking around to the end. If you like it, hit that like and subscribe button. Check out some of the links that we have down in the description below. We've got some great free resources there. We also have our retirement launch kit, and we've got some great worksheets and things that can really help you to get some of this stuff organized if you're in that early stage. And if you want to learn more about some of the financial planning programs that we have two really great plans depending on what level you're at and what kind of plan we want to build out for you, the retirement time machine and the money evolution plan. So we'll have links to all of that stuff down in the description below. Check out our website and look forward to seeing you back in one of our next videos. Thanks.